Hi, my name is Ravi. Welcome to my channel, Payment Talks. Welcome back and welcome to part 1 of the Clearing and Settlement Methods Masterclass from Payment Talks. This is the foundation for everything that follows in this series. By the end of this video, you will understand the difference between clearing and settlement, what finality actually means, and exactly when it occurs, and why the gap between a payment instruction and a final payment is where all the risk lives. When customer A taps send on a transfer of rupees 5 lakh from SBI to HDFC, one thing happens. An instruction moves, the money does not. Between that instruction and the moment the transfer is irrevocable and unconditional sits an entire structured process. That process has two stages. The first is clearing. Messages are exchanged, obligations are calculated, payment instructions are validated and netted. No money moves in clearing. The second is settlement. Accounting entries are posted at the central bank, value transfers, and finality is achieved. In the gap between those two stages, three risks sit waiting: settlement risk, liquidity risk, counterparty risk. Every settlement method in this series is a different answer to the same question: how do we close that gap? At what speed, at what cost, and with what risk control? To understand the gap, start with the four players who operate the infrastructure that closes it. Customer A initiates the transfer. That instruction goes to SBI, which is customer A's bank. SBI is the debtor bank. It initiates the payment, ring fences the funds internally, and holds a current account at the Reserve Bank of India where the settlement will ultimately occur. SBI submits the payment message to NPCI. NPCI is the clearing infrastructure for India's domestic retail payments. NPCI receives messages from all participating banks, validates them, calculates net obligations, and passes net settlement instructions to RBI. No money resides at NPCI. It holds notional obligation tracking accounts only. RBI is the settlement agent. It is the only place where settlement happens. Every bank in the clearing system holds a current account at RBI. When RBI posts its accounting entries, that is settlement. That is finality. HDFC is the creditor bank. It receives clearing information during the process, but it credits customer B only after RBI confirms settlement. A bank that credits customers before RBI's confirmation is carrying settlement risk on its own books. Customer A and customer B see none of this. They see a debit and a credit. The infrastructure exists to make that invisible process reliable, risk controlled, and final. So, what is clearing? It is not what most people assume. Clearing is a message process. Three functions define it. The first is matching. The clearinghouse verifies that both sides of the obligation align. SBI's instruction to pay rupees 5 lakh to HDFC is matched against a valid HDFC receiving entry. No payment advances without a valid match. The second is validation. Every message is checked for format compliance, AML and sanction screening, and routing accuracy. ISO 20022 messages in packset format carry the payment instruction. A rejection comes back as a PAX2 to the sending back. The third is netting. If SBI sends rupees 5 lakh to HDFC and HDFC sends rupees 2 lakh to SBI, within the same clearing cycle, the net settlement obligation is rupees 3 lakh, not rupees 7 lakh gross. That reduction in is netting. It is the core efficiency mechanism behind deferred net settlement, which is part 2 of this series. Throughout all three functions, not a single rupee has moved. Clearing is entirely a message and calculation process. NPCI does not hold money. This is one of the most persistently misunderstood facts in domestic clearing. NPCI maintains notional clearing accounts. These are obligation tracking ledgers. When SBI's payment instruction is processed, NPCI records a notional debit against SBI and a notional credit against HDFC. These entries say SBI owes this amount, HDFC is owed this amount. That information is precise, but no value has transferred. NPCI tracks these positions across all banks across all payments in a clearing cycle. At the end of the cycle, the net positions flow to RBI as a settlement instruction. What lives in the notional account today becomes a real debit or credit at RBI when settlement runs. That transition is where everything changes. Settlement is where the accounting happens, and only at one specific moment does it become final. Settlement operates in two states. They are not interchangeable. The first is provisional. An accounting entry has been recorded, but it is reversible. The value appears to have moved. Counterparty risk has not been eliminated. Banks that credit customers in a provisional state are absorbing settlement risk onto their own balance sheet, often without acknowledging it. This is not a theoretical concern. In correspondent banking, value can sit in a provisional state for hours before final settlement occurs. The second state is final. The accounting entry is irrevocable and unconditional. No party can reverse it. Counterparty risk is eliminated. The payment is legally complete. The gap between these two states is where hidden risk accumulates. A bank that treats a provisional entry as final is not just making an accounting error, it is carrying unacknowledged settlement risk on its balance sheet that may not be visible to anyone managing that risk. Finality, the moment at which a transfer of funds becomes irrevocable and unconditional. Counterparty risk is eliminated. The payment is legally and operationally complete. In India's domestic clearing, finality occurs when the Reserve Bank of India posts the accounting entries debiting SBI's current account and crediting HDFC's current account. Not when customer A sends the instruction, not when NPCI processes the message, not when HDFC receives the cleared payment information. At RBI and nowhere earlier. This is not technical jargon. Finality is a legal concept. Regulators define it in legislation because the moment counterparty risk transfers must be enforceable in a court of law, not just agreed between banks on a phone call. Now, trace the complete journey. Rupees 5 lakh, customer A at SBI, customer B at HDFC, stage by stage, entry by entry. Before SBI sends anything to NPCI, it takes one critical internal step. Customer A's current account is debited rupees 5 lakh. That same amount is credited to SBI's internal clearing nostro account. This is a ring fencing act step. The funds have not left SBI. They have moved from customer A's account to an internal holding account that SBI maintains for payments in transit. Customer A cannot access this money. It is set aside pending settlement. Only after this internal entry does SBI generate and submit a payment message to NPCI. Key point, this entry is SBI's only. No one else can see it. No money has left SBI. And until RBI posts its entries at the close of this process, the SBI clearing nostro will hold rupees 5 lakh in suspense. I already explained all the accounts, including differences between suspense and clearing nostro accounts. Refer to the previous article for more clarity. NPCI receives SBI's backside. It does not simply forward it. First, NPCI validates the message. Format checks, AML and sanction screening, routing verification. If the message passes, NPCI appends a clearing system reference ID, the CSID. This is NPCI's own tracking reference for this payment through the clearing cycle. NPCI then forwards the same packet to HDFC, now with the CSID attached. This is not a new message. It is the original instruction from SBI with NPCI's reference number added. Simultaneously, NPCI sends a PAX to acknowledgement back to SBI confirming the payment instruction has been accepted. HDFC has now received a clearing message. It knows a payment is in flight, but note, settlement has not occurred. Until RBI confirms, HDFC has no confirmed right to those funds. The message is information. It is not money. While NPCI is processing messages, it is also tracking obligations in its notional clearing accounts. SBI's net payable position is recorded. Rupees 5 lakhs notional debit. This means SBI owes rupees 5 lakh to the clearing system. Against that, HDFC's net receivable position is recorded. Rupees 5 lakh notional credit. HDFC is entitled to receive rupees 5 lakh. These are obligation tracking entries only. No value has moved. The notional positions update continuously as more payments flow between the same banks in the same clearing cycle. If HDFC also sends rupees 2 lakh to SBI during that same cycle, NPCI nets the positions automatically. The net settlement instruction to RBI reflects the final net position, not individual gross amounts. This is netting, and it is a primary efficiency mechanism that DNS systems rely on. We examine it in full in part 2. This is the slide that matters. At the close of the clearing cycle, NPCI passes the net settlement instruction to RBI. RBI debits SBI's current account at RBI by rupees 5 lakh. RBI credits HDFC's current account at RBI by 5 lakh. This is the moment. This is finality, not the instruction, not the clearing message, not the packet received by HDFC. This accounting entry at RBI. From this moment, the payment is irrevocable. SBI's debit cannot be reversed. HDFC's credit cannot be undone. Counterparty risk is eliminated. The payment is legally complete. Every risk we have discussed and every risk we will name in a few moments lives in the time between customer A's instruction and this entry. When this entry posts, all of them end. RBI then issues a net position set statement to SBI and HDFC confirming the net amounts settled for each bank in this cycle. Once RBI's settlement is confirmed, HDFC begins its internal accounting. HDFC's clearing nostro account is debited rupees 5 lakh. This is HDFC's internal record that the incoming funds have arrived and been settled. Customer B's account is credited rupees 5 lakh. Customer B now has access to the funds. HDFC uses two separate reports to reconcile this settlement. The RBI net position statement tells HDFC how much in total landed in its RBI current account. That is the cash and liquidity reconciliation tool. The NPCI clearing reconciliation report is different. It contains the individual payment details, every payment included in the net settlement, broken down by transaction. This is the payment level source of truth for back office reconciliation. Banks use it to confirm which individual payments are in which settlement cycle and to reconcile each entry in their clearing nostro accounts. Both reports are necessary. They answer different questions. Now, see the entire journey in one view. Every participant, every accounting entry, every status. Stage 1, Pre-clearing. Customer A is debited at SBI. SBI clearing nostro is credited. Both entries are internal to SBI only. No money has left SBI. Stage 2. Clearing. NPCI notional accounts are updated. SBI's notional debit, HDFC's notional credit. No real value, obligation tracking only. Stage 3. Settlement. SBI's current account at RBI is debited. HDFC's current account at RBI is credited. Final settlement. This is the only entry in the entire table where real value moves irreversibly. Stage 4. Post settlement. HDFC's clearing nostro is debited. Customer B is credited. Internal to HDFC only. Post confirmation. Look at the table. 4 stages, multiple participants, multiple entries, one moment of finality. Everything before the RBI entry is provisional or internal. Everything after it follows from that single irrevocable act. That framework applies to every settlement method in this series. The infrastructure changes, the logic does not. Please concentrate on this message and report flow. This tells the same story of complete clearing and settlement process in a glance in a different form. SBI submits the pack site to NPCI, that is the payment instruction containing full payment details. NPCI returns a PAX 2 to SBI with acceptance or rejection. NPCI forwards PAX8 plus the CSID to HDFC. Same message with NPCI reference added, not a new message. NPCI sends the net settlement instruction to RBI. This is the trigger for RBI's accounting entries. The clearing cycle ends here. RBI sends its net position statement to both SBI and HDFC. This confirms the net debit and credit amounts posted to each bank's current account. This is cash reconciliation. NPCI sends the clearing reconciliation report to both banks per cycle or end of day depending on the bank's arrangement with NPCI. This contains individual payment details. This is payment level reconciliation. 6 messages and reports. 6 steps in the communication chain. The pack site starts the process. The clearing reconciliation report closes the loop. This is the clearing and settlement process in nutshell. Now, understand why all of this precision is not optional. The lesson came on a single date, 26th June 1974. In the morning of 26 June 1974, multiple counterparty banks across Europe completed the first leg of their foreign exchange transactions with Bankhaus Herstatt in Germany. They transferred Deutsche Marks irrevocably into Herstatt's account. Their leg of the trade was done, final, unconditional. Under German law, those payments could not be reversed. At 3:30 in the afternoon Frankfurt time, German regulators closed Bankhaus Herstatt. The bank ceased to operate. At that moment, it was 10:30 in the morning in New York. The US banking day was fully open. Herstatt was due to deliver US dollars to those same counterparties through its New York correspondent, Chase Manhattan Bank. Chase Manhattan suspended all outgoing payments from Herstatt's account. The counterparties had paid their side irrevocably. They never received their dollars. One leg was final, the other never happened. The gap between those two events was not a technical inconvenience, it was a structural flaw. Banks lost funds they could not recover, and the industry had no legal framework for finality that could protect them. That event defined what we now call Herstatt risk, the risk that one leg of a payment transaction achieves finality while the counterpart leg fails, because finality occurs at different times in different systems. Herstatt is remembered as a cross border FX failure. but the lesson is universal. Apply it to the domestic example we traced. If HDFC credits customer B the moment it receives NPCI's clearing message, treating that as final, and SBI fails before RBI settles, HDFC carries the loss. The gap between clearing and settlement at a domestic scale produces the same structural exposure. The question that Herstadt forces us to ask of every settlement method is this: where is finality? And what risk exposure exists in the gap before it? That question runs through every part of this series. The regulatory response to Herstadt was systemic, and it took 5 decades to fully embed. The first response was to define finality in law. The moment at which a payment becomes irrevocable must be legally binding and enforceable in court, not assumed or agreed between banks. The second was to mandate RTGS for high value payments. Real time gross settlement eliminates the clearing to settlement gap entirely. Each transaction settles immediately and individually, leaving no window for counterparty failure. The third was to drive payment versus payment settlement for foreign exchange. Both legs of an FX transaction settle simultaneously. No first mover risk, no finality gap between currencies. The fourth was to mandate central counterparties for risk absorption in systematically critical clearing markets. Every settlement method in this series is a direct response to one version of the problem Herstadt exposed. DNS manages the gap with netting and participation rules. RTGS eliminates it. Instant payments extend real time finality to consumers. INDA, INGA, and COW each address the cross border finality gap differently. The gap between instruction and finality is where risk lives. Let us name each risk precisely and then close with 3 common misconceptions that practitioners carry into real implementations. The 3 distinct risks exist between the moment customer A sends an instruction and the moment RBI posts its accounting entries. Settlement risk. One party has already performed and the counterparty fails to deliver before settlement completes. In this example, SBI's instruction reaches RBI, but HDFC cannot receive the credit because it has failed. The exposure belongs to the party that performed first. Liquidity risk. SBI's net payable to HDFC exceeds SBI's current account balance at RBI at the moment the settlement instruction arrives. Settlement fails not because of counterparty failure, but because of insufficient funds in the right place at the right time. This is the operational cost of settlement speed. RTGS systems require banks to hold larger intraday liquidity buffers than DNS systems because gross settlement on every transaction demands more immediate funding than netted settlement does. Counterparty risk. The counterparty defaults in the window between NPCI clearing and RBI settlement. All 3 risks have the same termination point, the RBI accounting entry. When that posts, all 3 end simultaneously. The first misconception: clearing and settlement are one step and they both happen at the central bank. They are not. Clearing happens at NPCI, it is a message process. No money moves. Settlement happens at RBI. That is where accounting entries are posted and finality is achieved. NPCI is the clearing agent. RBI is the settlement agent. They are different participants performing different functions. The consequence of conflating the two: a bank that treats NPCI's clearing confirmation as final settlement is carrying unacknowledged settlement risk on its balance sheet. The counterparty risk that exists between NPCI and RBI is invisible to that bank. In practice, this misconception appears in system design, in how reconciliation logic is built. and in how some banks describe payment status to customers. The payment is not done when clearing is complete. It is done when RBI posts. The second misconception: domestic settlement is always the same. One model, one rail, one process. It is not. RTGS handles high value, time critical payments, real time, gross, per transaction settlement, no netting, immediate finality, higher intraday liquidity requirement, and cutoff times apply. Miss the RTGS window and the payment does not get just slower, it gets routed differently or fails. DNS handles batched retail payments. Netting across all banks is in a clearing cycle. Periodic settlement windows. Significantly lower liquidity requirement because netting compresses the gross obligation before settlement. Instant payments handles consumer transactions around the clock. Real-time finality in seconds on pre-funded rails with hard position limits. No cutoff. Available 24 by 7. These are not alternatives. They are separate systems for separate use cases. Sending a payment to the wrong rail or missing a cutoff does not produce a slower payment. It produces a failed or delayed one. That routing decision is a design choice with real consequences. The third misconception: cross border payments without central clearing infrastructure are fundamentally different process from domestic payments. They are not a different process. The infrastructure is different. In domestic payments, NPCI sits between SBI and HDFC as a central clearing intermediary. The process is centralized, standardized, and efficient. In cross border payments, where no central clearing house exists between two banks, the same clearing and settlement process still runs. The clearing function is internalized into the bilateral banking relationship. Banks reconcile obligations through Nostro and Vostro accounts. They settle directly or through correspondent banks. No third party intermediary performs the clearing function for them. The result is the same two-stage process: clearing, then settlement, but without a central counterparty absorbing risk. Cross border bilateral settlement carries more counterparty risk, more cost, and less transparency. The clearing still happens. The infrastructure that houses it is the bilateral banking relationship itself. This is exactly why INDA, INGA, and COW exist. They are bilateral efficiency mechanisms that bring netting and settlement structure to corridors where no centralized clearing infrastructure exists. We examine each of them in part 5. Every settlement method in this series occupies a specific position on the clearing to settlement gap timeline. DNS, deferred net settlement, settles in batch at T plus 0 either intraday or end of day. The gap exists within the clearing cycle. Netting compresses the liquidity requirement significantly. That is part 2. RTGS, real time gross settlement, settles in real time per transaction at T plus 0. The gap is eliminated entirely. Each payment is final immediately upon submission and acceptance. This is part 3. Instant payments settles in seconds, 24 hours a day, 7 days a week on pre-funded rails. Consumer real-time finality with no cutoff window. That is part 4. Correspondent banking settles at T plus 1 to T plus 2. Cross-border, bilateral, no central clearing house. The gap persists between legs. INDA, INGA, and COW are structural variations that each address the gap differently. This is part 5. The regulatory direction globally has consistently been toward shorter gaps. T plus 2 to T plus 1, T plus 1 to T plus 0, batch to real time. Compressing the gap compresses the risk window. Settlement speed is a risk management outcome, not just a customer experience improvement. Three things to carry into every part of this series. First, clearing is a message exchange. No money moves. The clearinghouse validates, matches, and nets obligations in notional tracking accounts. Being in clearing is not the same as payment done. Second, Settlement is accounting. Money moves. Finality is achieved when RBI debits one bank's account and credits another. Everything before that entry is provisional. Everything after it is irrevocable. Third, finality timing is systemic risk, not a technicality. Headstart proved it in 1974. Every method in this series manages the finality gap differently. The question to ask of each one is always the same: where does the finality fall, and what exposure exists in the gap before it? In part 2, the same infrastructure runs across multiple banks simultaneously with real netting calculations across an entire batch. The clearing to settlement gap is examined in full, including the liquidity mechanics that make DNS the workhorse of domestic payment systems globally. If this video gave you clarity, subscribe to Payment Talks and follow the series. Until next time, keep smiling and keep learning. Thanks for watching this video. If you like this video, please like, subscribe and share for more such interesting topics on payments.